Greg, where do we begin?
Boy, that's a good question. I think the easiest of the sections that you talked about was one that's a common, like a Finance 101 discussion.
Gotcha.
That says you use short-term money for short-term purposes and long-term money for long-term purposes.
Explain a short-term purpose.
Short-term purpose, typically, most commonly, is like receivables money. Funding
yes.
against your accounts receivable.
Yes.
While you're waiting for the money to come in, but you don't want to miss the next opportunity, and so it gives you cash flow in that lag. The thing about that is that the payment, the repayment you might say, comes from when that particular account receivable comes in theory. Collectively, that's usually done as a line of credit with a multitude of accounts receivable backing up a total line of credit. But when you use it, you could actually very reasonably go through it and assign repayment from particular receivables when they come in, so it matches up. In theory, it should match up.
So, okay, I've got $100,000 in receivables, and I sell to New York City. So we do not, we don't get paid for at least 90 days. So I could take a loan on my accounts receivable, and once that receivable is paid, the bank or the lending institution gets their percentage, and we send everything back to the bank. Is that the way it works?
Ideally, yes.
Okay.
Because if you do that, you'll never get in trouble.
Gotcha.
The problem with it, it's not materially different from what you see people do with credit cards in the consumer realm. And that is, if you finance something for a longer period than that something provides benefit to you, you're slowly losing.
So in other words, you get a line of credit, and it's supposed to take care of your receivables. What you're saying is maybe the line of credit isn't the right way to go to finance receivables.
No, it can be okay for the receivables, but don't use it to buy a piece of equipment.
Aha!
See, well, people will sit out there when they have that availability, they see a good deal on something, and they can't resist, they move on it right now.
Yeah, because they have this line of credit.
They have a line of credit, and you hate to go through that whole approval process again. It's a pain to do it. And then you look at the fact that, you know, maybe the last time you had something approved took several weeks, and you don't have several weeks, you want to move on this thing right now. So you have a tendency to react promptly and use your line, but you've just used your line of credit to buy a long-term asset, but the repayment on the line of credit is not generated by operating income. It's really generated from clearing receivables. And you also have people making mistakes in the other direction. But sticking to that one, I have a client I worked with, 25 years ago.
You're not that old.
Easily that, yeah.
Oh, okay.
Yeah,
you were 12.
I'm 26,
you were
I'm 26 now.
Oh, okay, all right.
Okay. And in doing that, I had a client who had a company that had very strong cash position and virtually no debt. And he was looking at all of his old equipment. He had some very, very vintage equipment. He upgraded it. Not a bad move. But he used his line. And then in the neighborhood of 10 to 12 months later, he was in the bank using his personal credit cards to generate enough cash to make payroll.
Oh.
And what he had done is he had, over that period of time, because it doesn't show up immediately, he had so bled down his line that when he actually had an increase in activity and had to make more sales and had to buy more inventory, etc., he ran out of cash. He got cash tight, and he was having trouble making payroll because he had it all tied up in equipment